Good afternoon, and welcome to the 29th Annual Opportunity Finance Network Conference. My name is Dan Letendre, and I do manage the CDFI lending and investing activities in Bank of America. And Bank of America is, again, the lead sponsor for the Opportunity Finance Network Conference, the industry's annual and most important gathering. As many of you know, Bank of America is also an active investor in CDFIs. We currently have loans, investments, deposits, and capital grants to over 240 CDFIs operating in all 50 states. At the end of last month, our CDFI portfolio exceeded $1 billion. CDFIs have used our capital for affordable housing, charter schools, community health care facilities, child care centers, small businesses, all in the nation's poorest communities. Our work with our 240 CDFI clients continues to be a source of pride throughout Bank of America. One of the really neat things about working with so many CDFIs in so many places is it provides us an opportunity to see firsthand the trends and developments in the CDFI industry, particularly in the area of raising capital and deploying capital. For years, decades really, we've seen CDFIs raise capital, mostly from the private sector, borrowing from banks, foundations, religious orders, and institutions, and combining that capital with subsidy, grants, tax credits, awards, mostly, not exclusively, but mostly, from the public sector. And CDFIs have built this model of private sector capital, public sector subsidy to do amazing things in low and moderate income communities. We have noticed, however, in the past couple of years, an interesting trend that is leading to the reversing, in many instances, of those roles. Whether it's the CDFI Fund, the Small Business Administration, the Federal Home Loan Bank, more and more public sector entities are providing capital, valuable capital, but debt capital to CDFIs. And that capital requires the CDFIs to obtain subsidy, in many cases outside of that capital source, and in many cases from the private sector. And it is this growing trend, capital from the public sector and subsidy from the private sector, that I'd like to spend just a few minutes talking to you today about. Without a doubt, the single biggest capital development this year has been the CDFI bond program. I want to congratulate the CDFI Fund leadership, Donna Gambrell, and the CDFI team in the CDFI bond program, Brian Rosenthal, Brian Jackson, Lisa Jones, and the rest of the team, for launching a valuable resource that I believe can transform capital for CDFIs. Why do I believe it's such a valuable capital source? Well, first, the size of the capital. At full strength, the CDFI bond program can provide $1 billion of capital for CDFIs each year. $1 billion. The Bank of America total portfolio to CDFIs is $1 billion. It took us 20 years to build the business to get there. And the CDFI industry, through the CDFI Fund, can provide that level of capital every year. By the end of this decade, the CDFI Fund, through the CDFI bond program, should have more capital into CDFIs than 5 times the Bank of America portfolio and more than the combined CDFI portfolios of the 10 largest banks in the United States. Anytime a new capital program is larger than the entire industry combined from the private sector, that's transformational. But it's not just the size. It's the term of the capital, 30 years fixed rate. Finally, CDFIs can originate long-term loans, charter school loans, community health care facilities, 30-year loans with 30-year capital. We don't have to finance charter schools with loans of 30-year amortization, but a 7-year balloon, and then we pray for 7 years that interest rates don't go up and blow up the refinancing prospects. Finally, asset liability management in a true sense. And the CDFI bond program can fund beyond that. In fact, the CDFI bond program is the perfect source for CDFIs that originate single-family home mortgages. We've long wanted CDFIs to be even more active in the home mortgage origination business, but how can we expect that if they didn't have a source of 30-year capital to make 30-year fixed-rate loans? Now we do. It is truly my hope that CDFIs become as important in affordable home ownership as CDFIs have long been in affordable rental housing. Now I know the CDFI bond program is not a perfect capital source. No capital source is. It requires full recourse. You have to pledge your loan receivables, and in fact, in some cases, with an over-collateralization rate. And you have to agree to performance and financial covenants and targets for the next 3 decades. But for those who doubt the program and shy away from its structure and requirements, I want to bring us back to the time when the New Markets Tax Credit Program was first introduced. Many of us, myself included, looked at the program and said, a 5% interest rate subsidy. We don't need an interest rate subsidy. We need a capital subsidy. And 7 years? We're financing 30-year assets. How can we use a 7-year tax credit to finance 30-year assets? Yet, CDFIs did what CDFIs do best. They took the subsidy source, turned it into a pretzel, and today, the New Markets Tax Credit Program is the driving force behind so much of the lending to charter schools, community health care facilities, and other facilities serving nonprofits across the country. I do believe that the history with the New Markets Tax Credit Program will be replicated as we all grow to learn and use the CDFI bond program. And so I want to congratulate and thank the 4 CDFI recipients in the CDFI bond program: Enterprise Community Loan Fund, LISC, CDFI Clearinghouse, and the Community Development Trust. I will always think of you as the pioneers of the CDFI bond program. You stepped in, even though all the details had not yet been worked out, with the idea that you will work out the details as we go. That's why Bank of America became a qualified issuer under the CDFI bond program, joining Opportunity Finance Network and the Community Reinvestment Fund as the 3 qualified issuers in the CDFI bond program. Because on the CDFI team at Bank of America, our mission is figuring out how to bring capital, valuable capital, to CDFIs for the benefit of your communities. I hope that other institutions become qualified issuers as well. Competition among the qualified issuers will only benefit CDFIs. And I hope that more and more CDFIs look into the bond program, explore the bond program, apply with the bond program, and close transactions in the CDFI bond program. Now, it's not only the CDFI bond program that I think is a recent capital source that has transformational potential. A couple of years ago, the CDFI Fund and the Small Business Administration came together to launch the Community Advantage Program, a small business finance program where this SBA provides 80% guarantee on small business loans up to $250,000 originated by CDFIs. Finally, CDFIs had access to the same kind of programs that banks have long had access to under the SBA 7A program. When I saw the introduction of the program, I truly believed that CDFI capital would flow like torrents to CDFIs. But that didn't happen. In fact, in the first full fiscal year after the program, the 50 Community Advantage CDFIs originated 182 small business loans, about 3 per CDFI per year. Not what we expected, and I know not what the SBA expected. And so for much of the past year, we at Bank of America have been meeting with CDFIs to learn what doesn't work, what does work, and what could work in the program. We will be announcing next month a new program specifically targeted to a selected group of Community Advantage participants to help bring the Community Advantage program to the potential we think it can achieve. It has 4 components. First, acknowledging that the Community Advantage program requires capacity building inside CDFIs. It requires hiring, systems changes, training. We will provide the required philanthropic support for these Community Advantage participants to do the capacity building necessary. Second, we will provide low-cost financing, flexible lines of credit, just-in-time financing, all below 3% or below interest rate, for CDFIs in the Community Advantage program to originate CDFI loans, bundle them, hold them in the anticipation of selling them in the secondary market, where today CDFIs can receive a premium for selling the guaranteed portion of the loan. That premium can help subsidize the operations at CDFIs. Third, recognizing the complexity of the program and the importance of maintaining the guarantee in the loans, we at Bank of America have assembled a team of subject matter experts in SBA 7A and Community Advantage to assist on a pro bono basis CDFIs that are having issues with the Community Advantage program, or to discuss how to work through the programs and put the policies and procedures in place to make sure that you don't lose your guarantee on the loans you originate. And finally, in talking to many CDFIs, we've heard that in the size where the Community Advantage can really kick in, they may not see enough deal flow, borrowers needing that amount of capital coming to the CDFIs, and so we will launch with those select Community Advantage CDFIs a program that refers small business applicants from Bank of America to the CDFIs that can serve them. Now, maybe this won't be the solution. Maybe we refer the borrowers to the CDFIs, provide capital to the CDFIs to originate the loans, provide philanthropic support to end up providing capacity building for the CDFIs and the technical assistance to work through the glitches. Maybe then I might look for other programs. But I don't believe that's going to happen. CDFIs are too innovative, too creative, too committed to bringing capital to low-income communities to allow that to happen. When it comes to bringing capital to communities, I'll bet on CDFIs every time. And so as we move forward in an environment of changing roles of capital and changing roles of subsidy, we at Bank of America believe the following. First, for those of us who are capital providers, if we expect CDFIs to provide the kind of impact that we know you can, we must also bring subsidy. And we must bring our capital, design our capital in ways that can tap into easily the capital sources, the subsidy sources that are already in the marketplace. And those of us who are subsidy sources need to design our subsidies to work well with the capital, to leverage the capital that is already in the system. Second, our low and moderate income and underserved communities need CDFIs today as much as they ever have, perhaps more. We need more capital to more CDFIs in more places. And third, whether we are private sector, public sector, or CDFI, each of us needs to dig in around the capital sources that are available so we can figure out how to bring the capital and make it work for our communities. I want to tell you that it has been my honor, my privilege for the past 20 years to serve CDFIs as clients. For all the work that you do and all the difference that you make, I truly thank you. Please enjoy the conference.